Binary options promise something almost no other market does: you can know your exact profit and your exact loss before you even click the button. That sounds either amazing or terrifying, and by the end of this video, you'll know which one it actually is. Welcome back to Aurea Trader Academy. I'm going to break down binary options the same plain English way we break down every tool on this channel: no jargon, no fluff, just what you actually need to know before you risk a single dollar. This is Lesson 1, Binary Options Basics. Let's start right at the foundation. By the end of this lesson, you'll be able to explain binary options to someone else, from scratch. We're covering 4 things: what a binary option actually is, the difference between a call and a put, exactly how payouts get calculated with real numbers and where this is even legal, plus the real risks nobody puts in the ad. A binary option is a short-term contract on exactly one question: will this asset's price be above or below a set level, by a set time? Get it right, you receive a fixed payout. Get it wrong, you lose your stake. There's no partial win, no in-between. That's literally where the word binary comes from. Every single binary options trade boils down to one of 2 bets. A call means you're predicting the price will be above the strike price when the contract expires. Basically, I think it's going up. A put means the opposite: you're predicting price will be below the strike at expiry. I think it's going down. That's it. 2 directions, nothing else. Before you click anything on a real platform, read 3 numbers. The strike price, the exact level your prediction is measured against. The expiry time, when the trade settles, anywhere from 30 seconds to a few hours. And the payout rate, the percentage of your stake you get back if you win, say 80%. Let's make this real. Euro to US dollar is trading at 1.0850. You pick your asset, euro to US dollar. You pick a direction, you think it's rising, so you open a call. You set your stake at $50. You choose a 15-minute expiry, with the strike locked at 1.0850. 15 minutes later, euro to US dollar sits at 1.0857 above the strike, so your call wins. You'll see 2 terms on every platform screen. In the money, or ITM, means your prediction was correct, you get your stake back, plus the payout percentage. Out of the money, OTM, means you were wrong, and in most binary structures, you lose the entire stake. No partial refund, no matter how close you were. Here's the math that catches people off guard. Stake $50 at an 80% payout, and a win nets you $40 profit, $90 total back. But miss by even a fraction of a cent, and you lose the full $50. Same loss whether you miss by a hair or by a mile. A win pays you 80 cents on the dollar. A loss costs you 100 cents on the dollar. That means you need to be right more often than you're wrong just to break even. Not all platforms are equal, and this matters for your money's safety. Regulated exchanges, like Nadex or the CBOE in the US, are licensed, supervised, and hold client funds to legal standards. Offshore, unregulated platforms are the most common source of scam complaints: no licensing oversight, frequent withdrawal problems, and pricing that can be quietly tilted in the broker's favor. And here's something a lot of ads conveniently leave out: retail binary options trading is restricted or banned outright in several major markets. The European Union banned it for retail clients back in 2018. The UK made its ban permanent in 2019. Australia banned it in 2021. In the US, it's restricted to CFTC-regulated exchanges only, no offshore brokers allowed. And in Israel, it's banned outright. Rules vary by country and by broker license, so always confirm what's actually legal where you live. So why is this considered high risk? 4 reasons. It's all or nothing. A near miss costs exactly as much as a total miss. Payouts sit under 100%, so the math is stacked against you by design. Timeframes are often just minutes long, leaving little room for real analysis. It can end up closer to guessing. And the fast results tempt revenge trading after a loss, which compounds losses fast. Quick recap of the vocabulary you'll see everywhere: strike price, expiry, call, put, ITM, OTM, payout rate, and stake. Pause here if you want to screenshot this glossary, you'll want it later. Here are the mistakes that wreck beginners fastest. Trading with no plan, clicking call or put on a hunch. Chasing losses, raising your stake right after a loss to win it back quickly. Ignoring regulation, depositing with an unlicensed offshore platform. And skipping risk management, risking a huge share of your account on one single trade. Now that the basics are locked in, the next lessons build your actual trading skill. Lesson 2 covers trends and reversals. Lesson 3 is candlestick basics. And Lesson 4 is risk management, the discipline that keeps you in the game. Before we wrap up, here's everything in 5 lines. A binary option pays a fixed amount if you correctly predict price direction by a set time or you lose your stake. Call means you're predicting price rises above the strike, put means below. Payout rates are typically under 100%, so being right just over half the time isn't enough to profit. Only trade on regulated platforms, and confirm binary options are actually legal for retail traders where you live. And this is high risk, short-term speculation. Never trade money you can't afford to lose. One more time, because it matters, this video is educational content, not financial advice. Binary options are a high-risk, speculative product, and they're restricted or banned for retail traders in several countries, including the EU, UK, and Australia. Only trade on regulated platforms, confirm the legal status where you live, and never risk money you can't afford to lose. Want to check what you just learned? There's a free 10-question quiz with an answer key linked in the description. Go test yourself. That's lesson 1 in the books. If this helped, hit subscribe. Aurea Trader Academy posts a new lesson every week, and next up is trends and reversals, where we start actually reading a chart. Drop a comment if you have questions, and I'll catch you in the next one.